Welcome to Keep What You Earn, your judgment and jargon free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. You know, the downside of having so many different types of businesses and ways to measure metrics and finances is that with so many different options out there and so many different pieces of guidance and tips and tricks, it can be really hard to distill down like, what the hell should I even be tracking in my business? There are so many things I can track. And as a fellow data nerd, I feel you. I have dashboards on dashboards that I never read because they're so overwhelming because of so many things that we're tracking. And what I realized was I just wanted like a 3 to 5 bullet point summary of what's working, what isn't, and what action do we need to go take. That is when you hit kind of a CEO level mindset when you're just going, hey, give me the need to knows. So, as a fellow CEO, fellow business owner, I'm going to share with you the 5 money metrics that I think every CEO, every business owner should be equipped with, and that you should know relatively, even if it's a range, you should know off the top of your head. Okay. So if you're heading to your Shark Tank pitch, if you're heading to an investor meeting, if you're doing any sort of pitching, any sort of conversation around finances, these are great numbers to know. Okay. So study them and also make them part of your monthly routine, make them part of your monthly reporting routine. Ask your bookkeeper to help you develop these for yourself as a scorecard. Also, I will be coming out soon with an actual scorecard that shows you some of my favorite money metrics. That will be coming out very soon, but I'm going to share this with you so that you can start measuring these now and then download that scorecard as soon as it comes out. You'll be finding out on this show when that's coming out. So stay tuned. But let's go through the 5 metrics. So the number one metric is gross margin. Gross margin is kind of the same as your gross profit. We typically express gross margin as a percentage. What it is, it's gross profit divided by revenue. And just to recap, revenue is all of your total sales, everything that came in from you selling to customers. Then you subtract out your cost of sales or cost of goods sold, which is anything that directly relates to selling that item. So if it's manufacturing, shipping, processing, if it's a service, it could be the direct labor. So if you're running an agency, it would be the employees that serve that client, those clients. Anything that directly relates to providing that product or service to your customer. Now, that generates your gross profit. Okay. So that's like the top level profit. That is the core profitability of your offer. And that is like, if you do not have a strong gross margin, if you have no profitability at that level, we're done talking. You have to go work on that. And if your gross margin is low, don't worry. And I can tell you, it really just depends on your industry with what good looks like. So I'm going to tell you, if you're tracking your gross margin, which is typically, again, percentage, gross profit divided by revenue, look at industry standards for your industry. They are available. They are available on the internet. I promise you, I've Googled them myself and I have tons of resources on this. If you need help, let me know. Shoot me a message. I can help you with some resources. But we can help you with what good looks like, right? So if you work in a certain type of business and, gross margins are typically around say 65% or 70%, you'll know by seeing the industry standards of what to expect. You can do your own research and see what's typical of a business in your industry, but just keep in mind your size, your geography, etc. It might be a little bit different, but it will give you something to base it off of. Number 2, your net margin. So what this has a bajillion names, okay? So your net margin is your net profit divided by revenue. And your net profit differs from gross profit because your net profit factors in the subtraction from all of the operating expenses that it takes to run your business, not just provide your offer. So if you think about your P&L. The top section down to gross profit is to provide your offer. The rest of it is to run your business, right? Makes sense. So, do I have a profitable offer? Do I have a profitable business? They answer each of those questions. So, if you think about, okay, I have a profitable offer. Now, my net margin is net income, AKA net profit, over sales. So that again is expressed as a percentage typically, and you can do the same thing. You can research typical industry standards. Now, here's an interesting little nuance. What I would love for you to do, your net margin is typically the same, but understand we would really love to get EBITDA margin. Now, EBITDA, which I've covered on past episodes, EBITDA is a weird ass acronym. Bear with me. E, earnings. B, before. I, interest. T, taxes. D, depreciation. And A, amortization. EBITDA, EBITDA. Earnings before interest, taxes, depreciation, and amortization. What does it mean? It means the profit your company actually generated before you did any sort of tax tricks, or you have the cost of capital. So the cost of the basically interest expenses not being counted because we'll exclude those out. We'll exclude out taxes that you pay because it's not a real business expense. It's just basically getting counted out because it could really depend on what state you live in. So it's really, we're looking for what does the business generate from its operations that has nothing to do with any sort of tax impact. And depreciation and amortization are not cash out the door typically. Those are typically theoretical expenses because you're measuring this in your accounting as decline in value of stuff where you're not actually like paying depreciation expense every year. You're eroding the value of stuff that you buy as assets. And that's called depreciation or amortization. So, anyway, EBITDA is what we would love to have. But most people listening, most of you are going to have an EBITDA margin and net margin that are the exact same thing because most of you don't have any of this other stuff anyway. So if depreciation isn't really a factor in your P&L, you got nothing to worry about. Then it's basically EBITDA, same thing. So we want to look at your net profit over your revenue. That's your net margin. That tells you if you have a profitable business. So again, profitable offer, profitable business. Pretty good to know, right? Now I want to talk about the third one, net cash flow. Net cash flow means at the end of the day, is your bank account bigger after a week, a month, a year, a quarter, whatever, than it was at the beginning? So if over the course of the year, your net cash flow is positive, that means that your bank account grew, all things considered. So think about your bank account as like a building or a store or something where people come in and out of it. And if more people came in than left, you have more people in the building, right? It's pretty simple. But what we want to do is measure the flow, and figure out, hey, in a given month or quarter or year, what can we expect to keep in the bank account or add the bank account by? If we want to increase cash reserves, let's say you want to have $100,000 in the bank at any given point in time. Well, how much do we need to really be bringing in so that we're building our cash balance up so we can hit that goal? Looking at your net cash flow is how fast and by how much your bank account is growing. Okay. So net cash flow is that. Hey, real quick, are you learning anything in this episode that you think is share worthy? Well, if you could take a quick screenshot and share any of your biggest takeaways or quotes from this episode, post it to Instagram and make sure to tag me at Shannon K. Weinstein and at Keep What You Earn. Thank you so much for listening to the show. Let's dive back in. Number 4, revenue retention. Hear me out. Notice how I haven't used revenue as a money metric yet. Now, of course, you should know your revenue, but I want to go a step further. I want to talk about revenue that you make that is recurring and retained. So let's talk about what those mean. Recurring revenue, I'm going to be really specific in how I pronounce this. Recurring revenue is revenue that is essentially on autopilot. It's revenue that comes in every month, basically guaranteed, like it's contracted, it's on a retainer, it's on a membership. You can reasonably rely on the fact that this will be on repeat, okay? So if you look at our customers are on a monthly recurring revenue plan. For us, Now, there's reoccurring revenue, which means people buy from you over and over again. Think of like an apparel company. Think of, your favorite clothing store. You will go back to them over and over again, but you don't have a necessary subscription service where you're spending money on a consistent basis at the same amount at a set frequency. You are going to be going in over and over again, but probably every few weeks, every few months, you will re-up your purchases. That's reoccurring revenue. Now, the last thing is retention. So, retention is here's what this answers it's a percentage again. It's basically how much of your money that you're making now compared to the money you made last year, how much of it is the same customers? So, how many of your customers as a percentage do you retain year over year? Think of it that way. So, if you run a business similar to ours, we look at, okay, we had, customers that we had this many customers come in, we had this many customers leave, and then we had this increase over here. So it's basically looking at the revenue that you've kept from year over year. And you have to be honest with yourself of, okay, wait, did we have any clients that left? And if so, they're not included in the recurring revenue. Now you can measure this at any point in time. So you can do yearly revenue retention. You can also look at revenue retention quarter over quarter if you have a faster turnaround or faster transaction cycle. So for example, if you run an e-commerce business, you may want to be looking at revenue retention month over month or quarter over quarter, depending on what your buy cycle looks like, the most common buyer behavior. So you want to be looking at valuable timeframes to measure this in, but just understand that revenue retention is uh, how many of your clients have you kept? So that answers how many clients have you kept. Lastly, my favorite metric, which is client lifetime value divided by your client acquisition cost, lovingly known as the LTV to CAC ratio. I love this ratio, and this is something that, in particular, a lot of creators, a lot of business strategists really focus on this metric, including Alex Hormozy, who I've talked about before. He loves this metric, but I'm going to break down the two components of this. Client lifetime value means how much a client is worth to you. So let's just say you have a client system, kind of like ours, or you have an agency or you have a service, and you charge $10,000 a month for a client. On average, they stay for 2 years, okay? So that means every client is worth to you $240,000. Ah, but wait, that's revenue. It costs you, you know, let's say it costs you $5,000 to serve them. I mean, that would be crap margins, but easy math. It costs you $5,000 to serve them, but you charge them 10,000. So then technically that gets cut in half. So your lifetime value of them is actually the lifetime gross profit, which is the lifetime gross margin, same thing. So it's actually going to be $120,000 is what your client is worth. Why? Because your client is worth $5,000 of profit per month. We're looking at the profit, not the revenue. So for every client that comes in, you can reasonably expect to generate $5,000 a month net from that client just being in your presence, being enrolled in your service. Okay. Now that's before any operating expenses. We know that. But basically, that's the net impact of adding a client to your roster is another 5K of profit. Make sense? Cool. So now when we look at the lifetime value, we want to say, okay, how long does a client typically stay with us and how much do they spend with us? And then how much does it cost to serve them? So figure that out ballpark. Ballpark, directionally correct is okay. It doesn't have to be perfect. Then what you want to do is then you have to go into, well, what is my client acquisition cost? Your client acquisition cost, bear with me, is if you add up all of the different costs on your P&L that are related to business development, client acquisition, content creation, podcasts, appearance at networking events, conferences, masterminds, whatever. If you're doing it for the purpose of lead generation primarily, then what you want to do is take all of those things that you bought or you paid for in the name of lead generation. And don't lie to me. There's a lot of stuff that you probably spent money on and said, "Ooh, I'll get clients out of this." And that's how you justified it. So if you use that to justify it, you're using it in this calculation. You're going to add it to your acquisition costs. And you're going to take all those costs for the course of, let's say, a year. And you're going to divide that by the number of clients you actually got. And this will probably surprise you. So if you've spent $50,000 over the course of the year and you've gotten 2 clients out of all of those different efforts, then technically your CAC is $25,000 per client. Now, does it actually cost you $25,000 to get a client? Probably not in the grand scheme of things, but bear with me with this being a great metric to use because it does teach you, I've spent this much and this is what I got out of it. And it does shed a light on that. So with your CAC, your client acquisition cost, what you're going to want to do is be honest with yourself on how much you spent and how many clients you actually acquired. But also just keep in mind that if you can specifically identify a primary source of clients, and you can identify how much it cost you. So in particular, if you let's just say you bought tickets to an event and you walked away with 2 clients. You could literally say that the clients cost you a certain amount of money. But the purpose of this exercise is to figure out on average a blended CAC rate, if you will, that it takes you to get a new client. So the LTV to CAC ratio is basically the profit of a customer, the value of them in terms of profit over, AKA divided by, the cost to acquire them. So if this should be a multiple. So for example, if it's a 2-to-1 ratio, AKA it's a 2.0 when you do this math, if it's a 2.0, that means that a client is worth twice what you pay to acquire them, which is a good thing. But a lot of folks are saying that you want to have this be super high. You want this to be, 6, 8, 10, up in that range. I say when you're starting out, you should just want it to be positive. But I would say what good looks like for you is really going to depend on your industry, your age in business, and the types of lead generation activities you're doing. Because what this could reveal, aside from, if you see an LTV to CAC ratio and you're like, ooh, this is actually really low, it's less than 1, that's not good. What I would do is say, okay, then I think you're A, not spending the time on the right lead generation activities because you're spending more money than you need to for the clients you're acquiring. B, you need to go into the clients that you have acquired. Where were they? Do more of that. And number 3 is look at the lifetime value of your clients, because if you're looking at the clients that you have, are they staying? Or is the lifetime value low because they're not sticking around long enough? Your pricing isn't high enough. This is basically a catch all metric that identifies so many different levers that you can pull and figure out what's wrong. So you can diagnose a lot of issues. So, again, these 5 metrics, in my opinion, are all you need to diagnose your next business move and figure out what you need to treat first, what you need to focus on. So, again, let's recap. Number 1, gross margin. Is our offer profitable? Number 2, net margin. Is our business profitable? Number 3, net cash flow. Is our bank account fatter than it was when we started? Number 4, revenue retention. Are we keeping our customers? And number 5, LTV to CAC. Are our clients worth more than what we pay for them? You can answer all of those questions with these metrics. And that's basically CFOing. This is what we do. This is what I spend time doing. I take my clients through a scorecard that includes all of these metrics, and we discuss it as a team, and we discuss what it looks like for your business, what the next move is, what we need to be working on next, using this as a guideline. And I'm telling you, it doesn't have to feel like the Wild West. You can actually just hone in on some of these metrics and really figure out what's wrong. And it's not just the surface level metric, but it's what's behind it. So if gross margin is low, then I go, okay, let's look at product cost. Let's look at our pricing. At least I know what to zoom in on and then start examining. This will actually point you in the right direction of what needs to get unclogged in your business to be able to move forward. Cool. So I hope you found this helpful. I love this stuff. I nerd out on this stuff all the time. If you want more information on how to get this done for your business, don't hesitate to shoot me a message. I love hearing from you. I love getting the email responses. I love getting the DMs. Please do reach out. Hey, small business owners, are you tired of juggling payroll, benefits, and HR tasks? If so, I want to introduce you to our payroll provider of choice, Gusto, the #1 rated HR and payroll platform trusted by thousands of businesses just like yours. With Gusto, you can streamline payroll, manage benefits, and more, all in one easy-to-use platform. But here's the kicker. When you sign up and run your first payroll through our special link below in the show notes, you'll score a sweet deal, a $100 Visa gift card. That's right. Just $100 for clicking the link below and get started to claim your reward. Don't let payroll headaches hold you back from building your team and growing your business. Join the Gusto family today and take the first step towards simplifying your HR processes while snagging a bonus along the way. Click the link in the show notes now to learn more and set up your payroll. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.